Hi, welcome to Market in a Minute. The election's over. The animal spirits are running wild. We also think about Buffett, classic value manager, very, very successful, obviously, has 50% in cash of his portfolio, over $300 billion. That makes you scratch your head a little bit, doesn't it? Where's the puck going? As Gretzky would say, you want to go to where the puck's going, not to where it's been. So we have some pretty strong opinions about how the market's going to change with Trump's new policies coming in place. A very, very business oriented sort of approach to government. So stock market update. We were looking for the markets to have a nice pop after the election and then the rollover. We're still thinking that. The pop's been stronger than what we expected. But the election results were much better than we expected, with the Republicans basically having a trifecta, what it looks like. It looks like they'll take the House. So the policies of lower taxes, lower regulation, lower government spending, lower crime, secure border, bringing manufacturing back to the U.S. with some tax policies, and then strong foreign policy will give a lot of basically really incentives to the overall market. So the market's basically discounting a lot of that up front, and then it'll grow over time, no doubt about it. So the earnings trends, we think, will probably be better than previously believed under the Biden administration. We caution a little bit, if you listen to what Musk said, there's going to be some short-term pain before the gain. And we see that clearly. The government's been spending like crazy. The third and fourth quarter have been huge in terms of government spending. If you go back and you look at this, so this is back in the end of 2019. The government spending under Trump was $4.8 trillion. 4.9, really, rounding up. $4.9 trillion. And then if you look at where we are with Biden, we're at $7 trillion run rate. So when Musk says that he can cut $2 trillion out of the markets, I think he probably can. That seems actually that's doable. And so that would be a 6.9%, roughly 7% hit to the overall economy. Plus there'll be some additional compounding factors with that. But roughly 7% hit to the economy if you take that $2 trillion out. So there needs to be strong economic incentives for the private sector. So if you think about that, we're replacing the government spending with private spending. That's really, really bullish over the longer term. So mergers are going to come roaring back, mergers and acquisition. We think that's going to really be a nice driver to the overall markets. And then, there's another theme that's developing besides AI and the Mag 7. So the market's going to broaden out in a big way. And there's a big theme that'll be occurring, that economic growth is going to be better. And then some of the areas that will perform well are cyclical, small cap, value. So a big shift in leadership. So we do expect a modest recession occurring when this government spending just naturally slows down because the election's over, but also likely because of what the Trump's administration will do in cutting back wasteful government spending. So we expected a modest pop in the overall markets. We got a big pop in the overall markets. Then we think that there'll be a modest decline going into the rest of the year, or flattening out. And then there is a bigger pullback later to come, maybe in the first quarter. Perhaps it comes this year, but there's just a pullback coming. So when we look at the government spending under Biden, the government has really expanded in a big way. And you can see all these government programs. Build Back Better, $2.2 trillion. American Families Plan, $1.8 trillion. You go on, $2.7 trillion. $280 billion on the CHIPS Act. That's not bad. Infrastructure, $2.5 trillion. American Rescue Act, $1.9 trillion. That's around $11 trillion of spending. So if you go back to more normal times and look at the pie chart of government spending, this is 10 years ago to give us some direction as to how it's gone. It was 18% back in 2014. So 18% compared to 24% currently. So what's happening? Why we're bullish about this is you're going to see more of the private sector, consumption, investment, exports, to be a bigger driver, to be a bigger part of the pie. So that's really good for the stock market earnings. Now the technicals. So we got that big pop, right? As we discussed, that big pop in the markets. You see here on the 1-year chart of the S&P. We hit the 50-day moving average and really had a nice increase off the 50-day. Went up through the channel like it did back in July. And then it's more overbought now than it was back in July. We had a roughly 8 or 9% correction in the markets in that July-August period. Came down to support, the support level. And now we are roughly 3% above the 20-day moving average. Back in July, we got to about 2.3% above the 20-day moving average. Why we point out the 20-day? It just gives you a sense for the overbought condition that's happening in the markets right now. We're nicely above the 200-day, so that's a little bit worrisome as well, that you could have a pullback because we have been so strong recently. Now, looking at the oscillator, so we like using the overbought, oversold oscillator, when to increase our positions or when to pull back our positions just on a short-term basis. So you could see that in August, as we discussed, we had that oversold condition. Boom, big rally. The market really likes buying these dips. So oversold again, big rally in September. And we have more along the way, a little bit of a modest pullback in October, and this market went higher. Then we had a nice pullback in November, or it started in October, ended in November, and then the election hit. Big move. So we think that this overbought condition will have to be relieved. So a little bit of a pullback is likely in front of us. And we see risk in the overall markets, quite a bit of risk. As we look at the valuations of the overall market, okay, so this is the S&P 500. We got to roughly 10 times earnings after the election. We got 10 times earnings after the recession. We did this again back in the 90s. We got to around 10 times earnings. In the 90s, we had that big move from 10 times to 25 times. This cycle, we had from 10 times up to about 22, 23 times. So we'll have to see how far it goes up. We think there's other areas of the market that can start to, investors to start to rotate in. If you think about Trump's policies, it's going to be really positive, I think, for the auto sectors. They're going to get off the EV mandate, which is really good. And like Ford, for instance, is losing $5 billion a year on their EVs. And that'll be obviously good for Tesla, as we've seen Tesla stock skyrocket. But also, he's talked about giving tax breaks or writing off interest when you buy a new car. That's really going to be really good for the auto manufacturers, as an example. So we think that the markets will broaden out pretty significantly. Valuation is a problem in the large cap area. We're going to see new leadership emerge. So it's not only AI and the large technology companies. So we think technology will slowly become less and less of a component of the S&P 500, and other sectors will pick up. The thing that we worry about, probably most at this point, besides the market being way overbought, is the 10-year Treasury. So I don't know if there's a video out there with Stan Druckenmiller. I like Stan Druckenmiller. He's really intelligent. He points out, kind of as we did, that inflation could be an issue. That's his biggest concern, that inflation comes back and you push the 10-year up over 5%. So right now the 10-year Treasury is at 4.3. We would be much more bullish on everything if it breaks back down through that 200-day moving average to be 4.2. So going in the negative directions on yield will make the stock market much more fairly valued instead of being very overvalued. So we're watching the 10-year Treasury. And then this is our thought, is that there's going to be a lot of profit taking, I think, in some of these stocks. Usually it happens in the new year, so you have more time to go without paying those taxes. However, there's a lot of stocks that are up really big. I would take some profits on those stocks. The stocks have moved really well. Take some profit and then take more profit after the new year. Warren Buffett's been taking profits all along. That cash hoard of 50%, that's really interesting. So just keep that in mind as well. One of the great long-term value investors has a really large cash reserve. He's looking at these valuations. I think he probably could, get some companies, more companies in there as well. Here's kind of what we're doing. Avanex, I got to talk about this because it was about 2-3 weeks ago we pointed it out, down around $5. They have that Alzheimer's drug, great phase 3 data, or did file it in Europe. I think they're going to get it approved in Europe. We think that the stock is probably at least worth $2 billion in market cap. It's $800 million. The stock is around 9. I think it's probably going to go to 20 or better. So I think it's getting a little bit, there's some selling coming in currently, but it'll break through that in our opinion. So we'll watch that one. We still like that one, still holding on to that one. Capri. Okay, Capri was crushed by the Justice Department coming out and suing Capri and Tapestry about having a monopoly on luxury handbags. That just doesn't make any sense to me. The government won the case. We think it's going to come back up again. We think that they'll try again, likely. The merger makes too much sense and allows both companies to compete with some of the big global gorillas in that space. The original deal for when Tapestry made them the offer back in around August of last year was for about $57 a share. It went over 50. Now the stock's 20. Okay, so at $20, even without an acquisition, this stock's really interesting. We think someone comes around and offers them 30, they might have to take it. But, likely this stock will go over time over $40 a share. Some of the things that we're doing is we bought DTE. It's a utility. That's kind of our way of playing the energy needs in the country, low risk energy stock that has some benefits from the increased demand for energy. It's pulled back nicely. We bought that last week. And then some of the other stocks we've been buying recently, we bought some Ford because of what's happening, small initial position. So we like that one as a turnaround play. AMD, we think that there's going to be another company that will gain market share in that AI chip space. So AMD is the prime beneficiary. We bought some Intel after the election. We sold some Intel as it popped so much. So that was a nice little trade. Pfizer looks really interesting in our mind. So Pfizer's a really cheap stock, pulled back quite a bit. Yields a really nice dividend. So there's opportunities in the overall market. It's in those beaten down stocks. We think that leadership will start to change. Keep in mind, M&A is coming back, so if it's overly discounted, there's some real value there. And then one more stock, Walgreens. Believe it or not, we're thinking Walgreens has bottomed out, has over a 10% dividend yield. If they cut the dividend, we think it's a positive. If they don't cut the dividend, we think it's a positive. The stock had a good quarter. It's washed out, and I think there's likely a lot of tax loss selling that occurred in that name. Be a really good name for next year. So please hit like, come to my website, Patrick M. CFA, and sign up for a hard copy of Market in a Minute. Take care.